Okay, picture this. Trillions, literally trillions of dollars changing hands every single day, often before the sun's even really up for most of us on the East Coast.
Yeah, it's kind of mind-boggling when you think about the scale.
Right. We're talking about roughly, what, $4.3 trillion zipping through Fedwire,
Hmm.
and maybe another $1 to $2 trillion coursing through Cheech PS. And these systems, they're basically these unseen digital arteries, mostly in lower Manhattan and nearby New Jersey.
Yeah, not exactly glamorous locations for the heart of global finance, are they?
Not at all. But it's, well, staggering to realize these somewhat obscure payment systems are really the backbone of global commerce. They're handling everything.
Everything from, grain shipments,
Yeah.
commodity deals.
To international debt settlements, huge stuff. But here's where it gets really interesting with this incredible volume, this like central nervous system of the world economy. It relies on a surprisingly concentrated set of pipes.
And that concentration, well, that's the crux of it, isn't it? While it brings, certain efficiencies, it's also created a situation where the U.S. dollar, the currency flowing through all this, has become what a lot of analysts are pointing to.
Like Josh Luberis in his book, The Dollar Trap.
Exactly. He argues it's become a potential single point of failure for the whole global financial system.
Okay, right. Let's unpack this a bit then. So our mission, yours and mine, in this deep dive is to really get a handle on how the U.S. dollar climbed to this dominant global position.
Mm-hmm. Understand the history.
Yeah, and explore the complex mechanics that, keep it there. And crucially, look at the potential vulnerabilities and the risks that come with this dependence.
We're aiming for those aha moments, right, to help you, the listener, see the bigger picture without getting totally lost in the weeds.
Exactly. No drowning in jargon, hopefully.
So if we trace it back, the origin story of dollar dominance really kicks off after World War II. Bretton Woods. The United States just came out of the war way ahead economically, and they held, well, the vast majority, something like 70% of the world's official gold reserves.
That's just a massive advantage.
Huge. And it gave the U.S. enormous clout in designing the whole post-war international money system.
Yeah, so at Bretton Woods in 44, the idea was stability, right? Create a stable global system. Keynes, the British guy, he proposed this new international currency, the Bancor.
Mm-hmm. The kind of neutral reserve asset?
Yeah, designed to pressure both debtor and creditor nations to adjust. But Harry Dexter White from the U.S. Treasury, he had a different plan. And, well, America had the gold and the economic muscle, so...
So White's plan won out.
Pretty much. The dollar became the anchor, fixed at $35 an ounce of gold. And the U.S. promised, to convert dollars to gold if other central banks asked.
Right, and then other countries pegged their currencies to the dollar. They had to manage their economies to keep those pegs stable.
And this led to something interesting, what Keynes called the transfer problem, but in reverse.
Yeah, exactly. Under this new setup, the pressure to adjust actually fell more on the countries running trade surpluses, like, a recovering Europe or Japan.
How so?
Well, they were earning dollars through exports, but they needed to do something with those dollars. They often ended up reinvesting them, buying U.S. Treasury bonds, which basically helped fund American growth.
Ah, okay. And the Marshall Plan played into this too, didn't it?
Absolutely. European nations got U.S. grants, used them to buy American goods. It just reinforced the whole cycle. Dollars flowed out, then flowed back. It cemented the dollar's role and got everyone used to using it for international trade.
You can see why American policymakers liked this arrangement.
Oh, definitely. It solidified the dollar's status, gave the Federal Reserve a lot of global influence right from the start.
But this whole system, pegging the dollar to gold at $35 an ounce, it wasn't built to last forever, was it? Seems inherently unstable.
No, not really. By the late 1950s, early 60s, Europe and Japan were back on their feet, exporting more. So the flow of dollars started to reverse. Gold actually started leaving the U.S. vaults.
Putting pressure on that $35 peg.
Exactly. And this gets us to the famous Triffin dilemma, right?
Explain that again quickly.
Sure. The world needed more dollars to finance growing global trade. But if the U.S. printed too many dollars to meet that demand, it would undermine confidence that those dollars could actually be converted to gold at the fixed rate.
Damned if you do, damned if you don't.
Pretty much. There's this built-in tension when one country's currency is also the world's reserve currency. Their domestic needs might clash with their international responsibilities.
And we saw that tension play out, didn't we? Like with the London gold pool.
We did. That was an attempt by the U.S. and several European central banks to keep the market price of gold near the official $35 level by selling gold if the price rose.
Didn't work out so well, did it?
No, the speculative pressure was just too strong. It collapsed in 1968. And you had countries like France getting vocal about America's exorbitant privilege, basically, financing its spending, including the Vietnam War, by printing dollars that others had to hold.
So the promise of convertibility became more about trust than actual gold backing.
Increasingly, yes.
Oh.
And this whole situation, this imbalance between dollars out there and gold in Fort Knox, it actually helped fuel the growth of something else, the Eurodollar market.
Ah, right. Offshore dollars. Explain what that was about.
Okay, so a Eurodollar fundamentally was just a U.S. dollar deposit held in a bank outside the United States, mostly London, initially.
Seems simple enough.
It sounds simple, but the implications were huge. Because these dollars were offshore, they weren't subject to U.S. banking regulations, things like Regulation Q, which capped interest rates banks could pay on deposits, or reserve requirements.
So banks in London could offer higher interest rates on dollar deposits.
Exactly,
Right.
which attracted deposits.
Yeah.
Especially from entities like Soviet bloc trade banks, for instance, who were maybe wary of having assets frozen in the U.S.
Interesting. Geopolitics driving financial innovation.
Absolutely. And London, which had lost some financial clout with the decline of the British pound, was eager to become a center for this new market. They had lighter regulations, which helped.
So it created this pool of dollars outside direct Fed control.
Precisely. And it became a kind of self-feeding loop. More deposits led to more lending in Eurodollars, creating more claims on those original dollars, all happening offshore.
But they were still treated as dollars for trade and settlement, right?
Functionally, yes. This Eurodollar market grew massively. Multinational corporations started using it heavily for working capital, for trade finance. It became this huge dynamic pool of offshore dollar liquidity.
And it played a role in the gold market, too.
Yeah, especially after the London gold pool collapsed. It became a conduit for speculation. And then in 1969, they established LIBOR, the London Interbank Offered Rate.
Ah, LIBOR. We heard a lot about that later.
Right. It became the benchmark interest rate for all sorts of lending in this offshore market. It basically tied global borrowing costs to this massive pool of dollars that the Fed didn't directly regulate.
Which sets the stage for the next big shift, doesn't it? The Nixon Shock in '71.
Exactly. The whole Bretton Woods system, based on dollar-gold convertibility, finally gave way. Nixon just unilaterally announced the U.S. wouldn't convert dollars to gold anymore. Pulled the plug.
But the dollar didn't just collapse, did it? Because this Eurodollar system was already humming along.
That's a key point. The Eurodollar market was so large and so embedded by then, there was still plenty of dollar liquidity sloshing around. The anchor shifted. It wasn't gold anymore.
Oh, was it then?
You could argue it shifted towards the private credit mechanisms, the plumbing that the Eurodollar market had pioneered. It was about the network, the usage, the sheer volume.
And this offshore system then played a big role in the next phase, like recycling oil money.
Huge role. After the 1973 oil crisis, when oil prices quadrupled, oil-producing nations were suddenly awash in dollars, petrodollars. The Eurodollar market was a primary channel for recycling those funds back into the global economy, often as loans.
So the Nixon shock didn't kill the dollar's dominance, it just changed the basis for it, from gold to something else.
It fundamentally changed it. And yeah, that something else really started to crystallize with the oil crisis and the rise of the petrodollar system. The world found ways to create claims on Fed money, faster than the Fed itself was expanding its balance sheet. But ultimately, the responsibility for stability still landed back in Washington. That's kind of the seed of the single point of failure idea.
Okay, so 1973 oil crisis, huge price spike, oil embargo, a massive shock. And suddenly, oil exporters have mountains of dollars. This is where the petrodollar system really kicks in, right?
Right. And what's really crucial to grasp here is this deal, mostly unstated, but definitely meticulously executed, between the U.S. and Saudi Arabia in 1974.
The core of the petrodollar agreement.
Essentially, yeah. Riyadh agreed to price all its oil sales only in U.S. dollars. That was huge. And importantly, they agreed to invest a large chunk of their surplus oil revenue back into U.S. Treasury securities.
And in return?
In return, the U.S. offered security guarantees, military support, weapon sales. It was a strategic bargain.
So this fundamentally shifted the dollar's anchor again, from gold, which Nixon had just cut loose, to oil, energy.
Pretty much. It created this built-in compulsory demand for dollars.
Yeah.
If you needed to buy oil, which basically every country did, you needed dollars first. It wasn't about gold anymore. It was about access to energy.
And it created this recycling mechanism. Oil money flows to producers, then flows back to the U.S. via treasury purchases.
Exactly. Lou Maurice calls it compulsory dollar recycling. It was a
Okay.
really clever move, linking the dollar to an essential global commodity.
So these petrodollars pour into U.S. treasuries, but also into banks, right? What did Wall Street do with all this money?
They didn't let it sit idle, that's for sure. Big banks like Citibank, Chase, they set up special sovereign advisory desks, specifically to woo these petrodollar deposits from the Gulf states.
And where did the money go from there?
Often they'd book the deposits in their London branches back into the eurodollar market and then lend them out. A lot went as syndicated loans to developing countries, especially in Latin America, but also Africa. This was the peak era of petrodollar recycling.
So dollars flow from oil consumers to producers, then to New York and London banks, then out again as loans to developing nations, a big loop.
A huge loop. But then came Paul Volcker at the Fed in the late 70s, early 80s. He hiked interest rates dramatically to fight soaring U.S. inflation.
The Volcker shock.
Right. And because many of those loans to Latin America were dollar-denominated, often with floating interest rates linked maybe to LIBOR.
Their borrowing costs suddenly went through the roof.
Exactly. It became unsustainable for many countries, triggering the Latin American debt crisis of the 1980s. It showed the global impact of Fed policy, amplified through this petrodollar-eurodollar system.
So the petrodollar deal wasn't just about oil pricing. It had these massive geopolitical ripple effects, linking U.S. monetary power with military commitments in the Gulf.
Absolutely. The anchor shifted from tangible gold to energy security and, frankly, geopolitical muscle. Dollars became essential not because of gold, but because you needed them for oil, for debt repayment, and for all the interbank dealings in that huge eurodollar market.
This really set the stage for the next wave of financial changes, didn't it? And it highlighted a new kind of vulnerability, the system's reliance on this continuous recycling and the U.S. ensuring oil flowed freely.
It did. And the end of the gold window also had this immediate, quite profound effect on global savings patterns, didn't it?
How so?
Well, think about it. If central banks couldn't convert their dollar reserves into gold anymore, what were their options? There weren't many truly safe liquid alternatives on that scale.
So they ended up buying U.S. treasuries.
Overwhelmingly, yes. U.S. Treasury securities became the default global reserve asset. They were seen as the most liquid, essentially credit risk-free store of value available in size. Foreign central banks and later OPEC nations investing their surpluses just ramped up their holdings of T-bills and bonds.
What drove that demand specifically, besides just lack of alternatives?
Well, factors like the dollar actually weakening after 1971 made treasuries relatively cheaper for foreigners. Plus, the Fed letting short-term interest rates rise made them more attractive to hold. There was even a kind of arbitrage opportunity involving eurodollar branches and the repo market that further boosted demand for T-bills as collateral.
Interesting. So it helped the U.S. finance its own deficits more easily.
Definitely a benefit for the Treasury.
And it cemented Treasury bills as this absolutely crucial piece of collateral in the global financial system, not just for central banks, but for private players, too, like money market funds that were just starting up then.
Exactly right. T-bills became the foundational collateral for the modern wholesale money system. Other countries could have issued more debt, maybe Germany or the UK, but their central banks weren't willing or able to expand the supply on the scale needed.
Only the U.S. offered that depth and liquidity.
That depth, that liquidity, and a central bank, the Fed, that everyone knew would ultimately stand behind its own government's debt, acting as a lender of last resort against it if needed.
Creating a kind of self-reinforcing loop. More foreign holdings make the Treasury market more liquid, which attracts even more foreign holdings.
Precisely. Each wave reinforced the last.
Okay, so we've seen the gold pig break down, oil become a new pillar, and treasuries become the core collateral. This takes us into the 1980s, right? The era of deregulation and massive financial engineering.
Yeah, the sheer volume of money sloshing around, especially those petrodollars and eurodollars, really started to strain the old Depression-era banking rules.
So the system itself started to change structurally.
It did. Policymakers, particularly in the U.S. and U.K., started easing regulations. The idea was to let Wall Street and the City of London compete more effectively in this increasingly global market.
What were some key deregulation moves?
Well, in the U.S., the Depository Institutions Deregulation and Monetary Control Act of 1980 was a big one. It phased out those interest rate ceilings, like Regulation Q.
Leading to more competition for deposits.
Fierce competition. Banks had to scramble for funds, which pushed them towards finding higher-yielding assets. At the same time, Volcker's high interest rates made managing interest rate risk critical, so financial futures markets exploded.
And this whole environment really fueled a boom in financial innovation, didn't it?
Massively. This is when you really see the takeoff of things like mortgage-backed securities.
Salomon Brothers, Fannie Mae.
Right, and high-yield bonds, junk bonds, pioneered by Michael Milken and Drexel Burnham Lambert. Plus, London had its big bang in 1986, deregulating its stock exchange, which brought in lots of foreign firms, especially American ones, further integrating global markets.
And derivatives became much more sophisticated.
Hugely important, especially interest rate swaps. Bankers Trust did a landmark swap deal back in '81 between IBM and the World Bank.
How did that work, basically?
It allowed entities with different borrowing advantages in different markets, say, one could borrow cheap fixed rate, the other cheap floating rate, to effectively swap their payment obligations to better match their needs, all done through an off-balance sheet contract.
Okay, so managing risk, but also creating new connections.
And creating massive volumes. The notional amount of these swaps, that's the face value the interest payments are based on, just skyrocketed. We're talking trillions upon trillions eventually. And most of it was linked to dollar interest rates, often LIBOR.
So that created even more embedded demand for dollars.
Absolutely. And then you had international regulations like Basel I, the first accord on bank capital standards. It was meant to make banks safer.
But it had unintended consequences.
Kind of. The way it calculated risk-weighted capital actually encouraged banks to move assets off their balance sheets through securitization, because highly rated securitized products often required less capital backing than holding the original loans.
So more mortgage-backed securities, more asset-backed securities?
Exactly. And it also spurred the development of things like credit default swaps, or CDS. JP Morgan's bistro structure in the late 90s was a key innovation there, basically using CDS to transfer credit risk off the bank's books.
So this whole era saw the spread of this dollar-based, securitized, derivative-heavy financial logic around the world.
That's a good way to put it. Financial engineering lowered borrowing costs, sure, and made markets deeper in some ways. Yeah. But it also created a much more complex, interconnected, and frankly opaque system. Leverage could build up in hidden corners.
The eurodollar market laid the groundwork, deregulation opened the door, and financial engineering provided the tools to really ramp things up, all still fundamentally revolving around the dollar.
And all this increased activity, all these complex products, they put even more strain and importance on the underlying plumbing, the systems that actually make the dollar payments happen.
Which brings us right to the clearinghouses. The stuff Luberis really bigs into. Fedwire, HPS, CLS.
Exactly. The unglamorous but absolutely vital pipes.
Okay, let's break those down. Fedwire first. That's the big one, run by the Fed itself.
Right. Fedwire is the sovereign core. It's a real-time gross settlement system, meaning each payment is final and settled individually using actual reserve balances held at the Federal Reserve banks.
So no netting. It's dollar for dollar, instantly settled.
Pretty much. It's crucial for banks managing their reserves, settling large value payments, moving collateral for things like repo trades, handling margin calls on derivatives. It provides that legal finality at the end of the day.
And if Fedwire goes down?
Big problem. Even a temporary glitch can send shockwaves because so much relies on it.
Okay, then there's CHPS, the Clearinghouse Interbank Payment System. That's different, right? It's private.
Yeah, GPS is owned and operated by the big banks themselves. And its main feature is that it uses multilateral netting.
Netting, so like offsetting payments.
Exactly. Instead of sending every single payment individually, CHES calculates the net amount each bank owes or is owed by all the other banks at the end of designated cycles. It drastically reduces the number of actual payments and the amount of liquidity needed compared to gross settlement.
Sounds more efficient.
It is, for certain types of payments. It handles a huge volume of large value transactions, especially for international trade, corporate payments, loan settlements, and crucially, the dollar side of many foreign exchange trades.
But there's a catch.
The catch is its dependence on Fedwire. To ensure settlement happens, CPS members have to pre-fund their net debit positions using funds held in their Fedwire accounts. So CHES relies on Fedwire liquidity.
Ah, okay, so they're tightly coupled.
Very tightly. And there's a risk, right? If one major CGPS member suddenly can't meet its obligations, it could potentially disrupt the whole netting process for everyone until enough liquidity or collateral is injected. It's efficient, But that efficiency comes with this operational coupling risk.
Like a group trip where one person forgets their wallet for the final settling up?
Kind of, yeah, but with potentially trillions of dollars at stake.
Right. And the third one is CLS, continuous linked settlement. That's for foreign exchange.
Yes, CLS Bank specifically tackles settlement risk in the FX market, what used to be called Herstatt risk,
Kerstadt risk.
named after a German bank that failed in the 70s. The risk that you pay out the currency you sold in an FX trade, but before you receive the currency you bought, the other party goes bust, especially risky with trades across different time zones.
Ah, so CLS fixes that.
It does. By using a payment versus payment mechanism, it settles both sides of an FX trade simultaneously. You don't pay out your side until CLS confirms it's received the other side. It covers the major currencies.
And how does the dollar fit in?
Well, for any FX trade involving U.S. dollars, the dollar leg has to be settled via FedWire through CLS Bank's account at the Fed. So again, CLS is critically dependent on FedWire operating smoothly, especially during its main settlement window, which overlaps with the New York morning.
So FedWire is the ultimate settlement layer for the dollar legs of both CEGPS and CLS?
That's the key. FedWire is the bedrock. And these three systems are constantly interacting. A single complex international transaction might touch all three,
And their peak activity times all overlap in the New York morning.
which creates this window of maximum stress and maximum vulnerability. A major disruption in that New York-New Jersey corridor, think power outage, major storm, telecom failure, cyber attack during that window, could have immediate cascading global consequences.
We saw a little flicker of that in 2021, didn't we, with that FedWire restart issue?
Exactly. It was brief, but it was a reminder of how sensitive the system is.
So despite all the tech, all the backups, the physical concentration is still a major risk factor, a single point of operational failure potentially.
It really is. Operational risk, cyber threats, and this geographic concentration are inherent vulnerabilities. Recovery sites often rely on the same regional infrastructure. And cyber attacks are a huge concern. Not just taking systems down, but subtly manipulating payment data could wreak havoc, especially in netting systems like CAPS.
Are regulators aware? Are things being done?
Oh, they're acutely aware. There are extensive resiliency requirements, testing, backup sites, but the sheer interconnectedness, the reliance on third-party providers for communications and data, it makes fully mitigating that concentration risk incredibly difficult.
Okay, so that's the formal plumbing, but Lou Baris also talks about these shadow pipelines, right? Things happening off the main clearinghouse tracks.
Yeah, things like FX swaps, repurchase agreements or repos, and the ongoing role of Eurodollars. These are massive, often off-balance sheet ways that credit, currency, and collateral move around the globe.
Bigger than the formal systems in some ways.
In terms of the sheer notional values involved, absolutely. The outstanding notional value of FX swaps is astronomical. The daily turnover in the U.S. repo market, where people borrow cash overnight using treasuries as collateral, is in the trillions. And Eurodollar liabilities, dollars held offshore, are harder to pin down precisely but likely dwarf the onshore U.S. money supply.
Wow. So what do these shadow pipelines do exactly?
They perform crucial functions. They enable what financiers call transformation, time transformation borrowing short-term to fund longer-term assets, collateral transformation using one type of collateral, like treasuries, to effectively obtain funding or another type of collateral, and jurisdictional transformation moving activity offshore to avoid certain regulations or taxes, like with Eurodollars.
Okay, so FX swaps, that's basically creating synthetic dollars.
In a way, yes. It's two parties agreeing to swap currencies now and swap them back at a future date at a pre-agreed rate. It allows someone with, say, euros, but needing dollars short-term, to get those dollars without taking outright currency risk. It's a huge market for short-term dollar funding globally.
And repos. That's all about collateral.
Primarily, yes. It's essentially a collateralized loan. Someone sells a security, like a treasury bill, with an agreement to repurchase it shortly after, maybe overnight, at a slightly higher price. The price difference is the interest. It's the grease that keeps the wheels of the financial markets turning, allowing holders of securities to raise cash easily and holders of cash to earn a bit of interest safely.
And Eurodollars are still around.
Oh, yes. Still a massive pool of dollar deposits and loans outside the U.S., operating under different regulatory frameworks. Still crucial for international trade finance and corporate funding.
But these shadow pipelines, they have their own risks, right? Especially the short-term nature of things like repo and FX swaps.
Huge risks, particularly rollover risk. Most repos and many FX swaps are very short-term, overnight, a few days, maybe weeks. They constantly need to be rolled over, renewed.
And if the lenders suddenly get nervous?
Exactly. In times of stress, Think March 2020 at the start of the pandemic,
Mm.
or the 2008 crisis. Lenders pull back. They hoard cash, they shorten maturities even further, they demand higher quality collateral. These crucial funding markets can just seize up
And that causes panic.
big time because so many institutions rely on this constant flow of short-term funding. Regulations put in place since 2008, while aiming to make banks safer, have sometimes pushed more activity into these shadow areas or concentrated risk in new ways. For instance, rules encouraging banks to hold lots of safe assets like treasuries means those treasuries then need to be constantly financed in the repo market.
So these shadow pipelines are like the circulatory system carrying the real liquidity, while the clearinghouses are just settling the net flows.
That's a great analogy. The volumes flowing through the shadow system dwarfs what you see in the final settlement figures.
And when these shadow markets freeze up, everyone scrambles for actual dollars, right? Real central bank money.
Precisely. All those synthetic dollars created through swaps, all that collateralized lending. When trust evaporates, everyone wants the ultimate safe asset, actual reserves at the Federal Reserve.
Which leads to the Fed having to step in not just domestically, but globally?
Yes, this is the major evolution. The Fed has effectively become the offshore lender of last resort for the dollar system. We saw it dramatically in 2008 and again in March 2020.
Through the swap lines.
Primarily through central bank liquidity swap lines.
Mm.
The Fed provides dollars to foreign central banks, who then lend those dollars on to commercial banks in their own jurisdictions who are desperate for dollar funding.
A necessary step to prevent global meltdown.
Arguably, yes. It prevented a complete seizure of global dollar funding markets,
Mhm.
but it's politically sensitive, right? The Fed's primary mandate is the U.S. economy. Extending massive liquidity lines globally raises questions about who bears the risk, moral hazard. It's tricky territory.
Okay, so this whole intricate system, the plumbing, the shadow pipelines, the Fed's backstop role, it obviously gives the U.S. immense power and leverage, doesn't it? Especially with sanctions.
Absolutely crucial point. Because almost any significant international transaction somewhere along the line is likely to touch the U.S. dollar system, usually via a correspondent bank account in the U.S.
Correspondent banks.
Yeah, basically foreign banks need accounts at U.S. banks to clear dollar payments. This gives the U.S. Treasury, specifically its Office of Foreign Assets Control, or OFAC, extraordinary reach.
They can just freeze assets.
They could order U.S. banks to freeze the dollar assets of designated entities or individuals, effectively locking them out of the global financial system. And because non-U.S. banks don't want to lose their own access to dollar clearing, they generally comply very quickly with U.S. sanctions lists.
So U.S. sanctions have global teeth because of the dollar's dominance.
Precisely. And it goes further with secondary sanctions, where the U.S. can penalize foreign firms for doing business with sanctioned entities, even if the business has no direct U.S. link. Plus, you have the phenomenon of de-risking.
De-risking.
Yeah, where banks facing high compliance costs and the risk of huge fines if they slip up simply decide to stop doing business altogether with entire countries, regions, or sectors deemed high risk. Even if much of the business is perfectly legitimate, it can lead to widespread financial exclusion.
So the power is immense, but using it aggressively could backfire.
There's definitely that risk. Overuse could accelerate efforts by other countries to find alternatives to the dollar system to reduce their vulnerability.
And beyond sanctions, this dominance factors into broader dollar diplomacy, right? Like IMF conditions or those Fed swap lines.
For sure. The conditions the IMF attaches to its loans, which are often denominated in dollars or SDRs heavily weighted towards the dollar, are a form of leverage. And deciding which countries get access to Fed swap lines in a crisis and under what terms, that clearly has geopolitical dimensions.
It's a powerful tool, but maybe one that erodes its own foundation if used too bluntly.
That's the debate. How much can you weaponize the system before people seriously start building alternatives?
Okay, so given all this complexity, the interconnectedness, the concentration, what are the main ways this whole thing could break? What are the key failure modes Luberis highlights?
Well, we've seen previews already, haven't we? Liquidity cascades. Stress starts somewhere, maybe a currency crisis in an emerging market like Turkey in 2018, or a funding market seizure like March 2020, or a geopolitical shock like the sanctions on Russia in 2022.
And the stress just transmits incredibly quickly through the system.
Exactly, because everyone is linked through these dollar funding and payment channels. A problem in one corner can rapidly drain liquidity from elsewhere as everyone rushes for dollars and safe collateral.
And it's not just traditional financial shocks we need to worry about, is it? The book mentions non-market triggers, too.
Right. Things like climate change impacts. Imagine a massive crop failure disrupting commodity markets and the trade finance underpinning them, or severe shipping gridlock snarling supply chains and payments.
And cyber attacks, which we touched on with the clearinghouses.
That's perhaps the nightmare scenario.
Yeah.
Luberis mentions simulations, like a hypothetical extended outage of SWIFT, the messaging network banks use. It could leave trillions of dollars worth of payments in limbo. The potential for systemic chaos is immense if a critical piece of the plumbing gets seriously compromised.
Wow. And even domestic politics in the U.S. can pose a global risk.
That's another key fragility. Because the world relies so heavily on U.S. Treasury debt as the ultimate safe asset and the dollar is the primary funding currency, things like political fights over the U.S. debt ceiling create genuine global jitters.
Because a U.S. default is unthinkable, but even the risk of it causes problems.
Exactly. Or even delays in routine functions, like Congress potentially delaying the authorization for the Fed to renew its swap lines during a crisis.
Yeah.
U.S. domestic political dysfunction can directly translate into global systemic risk because of this deep dependency.
So given all these potential failure points, this concentration, this reliance, it's no surprise people are looking for alternatives, right? Trying to build redundancy.
Absolutely. There's a lot of exploration happening, though it's still early days for most initiatives.
What kind of things are we talking about?
Well, China is actively building out its renminbi-based payment infrastructure. CIPS, their cross-border interbank payment system, is meant to be an alternative to GTPS for yuan transactions. They're also involved in projects like mBridge, exploring central bank digital currencies for cross-border payments.
Europe's working on a digital euro, too.
Yes, though the final design and role are still being debated. You also see regional efforts, ASEAN+3 in Asia, exploring currency swap arrangements, some talk in Latin America. People are proposing reviving the IMF's special drawing rights, the SDR, as a more neutral global reserve asset.
Central bank digital currencies, CBDCs, seem to be a big focus, too.
Yeah, the idea of creating networks where different countries' CBDCs could interact directly, potentially bypassing the current correspondent banking system for certain payments.
But all these alternatives face huge uphill battles, don't they, against the dollar's incumbency?
Massive hurdles. Luberis talks about the liquidity trust bootstrapping dilemma.
Yeah.
It's a classic network effect problem. Meaning a new payment system needs lots of users and liquidity flowing through it for people to trust it and find it useful. But nobody wants to be the first to use it until it already has lots of users and liquidity. It's hard to get started.
Hard to break into the club when everyone's already at the dollar party.
Pretty much. Plus, you have practical issues like capital controls in China limiting the yuan's free convertibility, and just the sheer depth, liquidity, and ubiquity of dollar financial markets, bonds, loans, derivatives. It's incredibly hard for any alternative to replicate that scale quickly.
So diversification is happening at the margins, but dislodging the dollar as the core is a monumental task.
For the foreseeable future, yes.
Okay, so let's try and pull this all together. This deep dive, drawing heavily on the dollar trap, paints a picture of a global financial system that's, well, incredibly efficient in many ways.
Yeah, the current system moves vast sums very quickly.
But it's profoundly reliant on one currency, the US dollar, and on a surprisingly concentrated set of infrastructure, mostly located in one small geographic area in the US.
And that reliance, as we've discussed, while it grew out of historical factors and market forces, has created what Luberis argues is a significant single point of failure vulnerability.
Because everything is so tightly interconnected.
Exactly. The clearinghouses, the shadow banking pipelines like repo and swaps, the global balance sheets denominated in dollars. It means shocks can travel incredibly fast. A problem anywhere can become a problem everywhere very quickly.
It really leaves you with a pretty stark takeaway, doesn't it? Building on that core argument from the book. It feels like the next really big financial crisis, if and when it comes, might not just be an American crisis or a European crisis. It might be a truly global event precisely because of this deep, tangled dependency on the dollar system.
That's certainly the implication, isn't it? Which really raises a fundamental question, something for you, the listener, to think about. What are the long-term consequences of living with this kind of centralized dependency? Is it sustainable?
And if it isn't, what would a more resilient, maybe more diversified global financial order even look like? And how could we possibly get there?
Big questions. No easy answers, but definitely worth pondering as we watch how this incredibly complex, vital, and potentially fragile system continues to evolve.